Thank you very much. Thanks to Larry and Olivier for inviting me, and thanks to the Peterson Institute. So there are many challenges for monetary policy in the modern world. There's politics and populism. May I start my remarks? Thank you.
You're introduced.
I'm introduced. Thank you. I need no introduction. I received no introduction. So the challenges for monetary policy include populism in politics. They include the new concerns about financial stability and all that entails. I'm going to talk mostly about a somewhat narrow but still very important constraint, which is the one that Olivier brought up, which is the low level of nominal interest rates and the constraints that poses for ordinary monetary policy. I discussed a paper at Brookings in the spring by Michael Kiley and John Roberts of the board, which looked at the implications for monetary stabilization policy for very low interest rates. And they found that with ordinary monetary policy rules, that with a 3% long-run nominal interest rate, that the economy would be at the zero lower bound, which I'll use equivalently with the effective lower bound, zero lower bound about a third of the time, with significant consequences for output stability and for hitting the inflation target. So I think that's the motivating constraint that I want to talk about today. My paper, which is somewhat encyclopedic, I guess like Olivier and Larry, has three main sections. And I'll maybe obviously only hit the highlights. The first section is about unconventional policy tools. The Kiley-Roberts result is about what happens when you only use short-term interest rates as your policy tool. But what about other tools that you can bring to bear? How do they work? To what extent can they supplement short-term policy interest rate movements? The second section of my remarks is about alternative policy frameworks. Are there ways of changing the framework of monetary policy to make it more potent, to give it more scope for action, even in a world of low interest rates? And then the third part of my speech, which I probably will not get to say too much about, but given the discussion just now, I want to say something about, is the question of central bank independence in the modern world. And that may seem like a totally different subject, but as was just illustrated, it's not totally different. The motivation for central bank independence in the literature, at least, is the inflation bias and the idea that independent central banks can prevent short-sighted politicians from creating too much inflation. How does that hold up in a world in which inflation is, if anything, too low, where politicians are too hawkish, and where interest rates are very low? And I argue in the paper, and I'll try to say a couple things about it, that the inflation bias argument was never, in my view, the main substantive argument for independence, and that the case for independence remains strong. That being said, there are circumstances in which central banks should work with governments, and I try to talk a little bit about what some of those circumstances are. So let me talk just a little bit about each of these three sections, starting with policy tools, going beyond the management of the short-term interest rate. I talk in my paper about four different types of supplementary tools: forward guidance, quantitative easing, negative interest rates, and what the Japanese call yield curve control, or basically interest rate pegging. The last two, negative rates and yield curve control, I believe have been effective. I believe they've been well executed. So please don't interpret anything I'm saying here as critical of those two tools. But I think that quantitatively they're somewhat less powerful. And I also don't think, parochially, I don't think they're going to be used in the United States in the foreseeable future. So in my remarks, I focus primarily on forward guidance and quantitative easing, and I'll just say a little bit about those two tools now. Now, there's a theme in throughout my discussion, really, which is the following, which is if you can't cut short-term rates down enough, if you can't reduce them enough, then a substitute policy is to promise to keep them low for a long time. So duration can substitute for the magnitude of the cut. And that's a theme that keeps coming up in the analytical literature. It comes up in some of these tools which I'm talking about. So to begin with forward guidance, for example, I make the distinction, which was first introduced, I believe, by Charlie Evans and some co-authors in a Brookings paper a few years ago, between so-called Delphic forward guidance and Odyssean forward guidance. Delphic forward guidance is guidance that just basically a forecast. Here's what the central bank think is going to happen. Think about the Fed's dots. Here's what we think the economy is going to do. Here's what we think policy is going to do. This is about, Delphic guidance is basically about trying to help people understand the Fed's thinking or the central bank's thinking, trying to understand the reaction function, just providing more information. But importantly, Delphic guidance is not in any way a commitment. It's just a forecast. Here's what we think may happen, but if circumstances change, we'll change. Delphic guidance is becoming increasingly relevant at all times, not just the zero lower bound. And most major central banks now do an awful lot of talking, both in formal mechanisms like the dot plot, but also in speeches and so on, trying to give as much guidance as possible about how they see the economy and how they see policy evolving. And I think that's constructive and makes policy more effective and more transparent. But it is different from Odyssean guidance, which Odysseus, of course, bound himself to the mast in the Greek literature. The idea of Odyssean guidance is to make a commitment or a near commitment, which may be contingent, about what policy will be in the future. And so there have been a number of examples of this. The Fed used thresholds for its rate policy in the recent recovery, where we said we were not going to raise rates at least until unemployment and inflation met certain criteria. The Bank of Japan is currently saying it won't raise rates until inflation overshoots. The European Central Bank has made commitments about its interest rate policy as well. And this forward guidance is intended to change rate expectations in the future and therefore to increase stimulus today. Now, two quick comments. One, of course, is that the traditional time consistency literature questions whether central banks can in fact do this. Can they in fact change market expectations of what policy will be taken in the future? And I think, despite the theoretical concerns, I think the evidence is that yes, that despite the fact that forward guidance has been developed a significant extent on the fly and in an ad hoc way, it has been effective, and the literature suggests that it has affected both market rates and forecasters' expectations of how the economy will evolve. And so in that respect, I do think that this is a very promising tool. I think we've learned a lot, and that in the future, forward guidance will be used quite regularly and I think effectively as we learn better how to commit to future policy actions. The other tool, quantitative easing, I want to talk about, also has, I just want to start by saying that it also has this forward commitment element to it. And this is, the ECB has been talking about this quite extensively, about the interaction between their asset purchase program and their rate policy and how those two things work together, and how in particular the asset purchase plans are important not just because of how they affect the balance sheet of the central bank, but because of what they signal about future rate policy. And likewise, the studies of quantitative easing suggest that one of the important mechanisms for the effectiveness of quantitative easing is as a signal about what central banks will do in the future. Confusion about that lay at the heart of the so-called taper tantrum in 2013. Happy to take questions about that. But it is very important to take into account the signaling aspect of quantitative easing. Now, on quantitative easing, critics have come at QE. I've said on a few occasions that quantitative easing works in practice but not in theory. And I think that's actually right. Many theorists, very good theorists, have argued that quantitative easing is just basically an asset swap and it's not really going to change the set of opportunities that investors have, and so it shouldn't do anything. I think that the evidence that QE does do something, that it works in practice, is pretty strong. There is an uncertainty about how big the effects are, exactly whether the channels are through signaling effects or to what extent they go through so-called portfolio balance effects. But Joe Gagnon here at Peterson did a survey, looked at a large number of studies, and I think there's very strong evidence that QE is effective, and I believe that it works both through the signaling and through the portfolio balance effects. And so it does represent an additional tool that can be used. I spend a lot of time at the other side of the critique of QE is, well, maybe it does something, but it's got all kinds of terrible side effects. I mean, it's good, maybe it's strong medicine, but it's going to kill the patient. And the sociology of QE criticism is actually kind of amusing. I mean, there's a number of people who have determined that QE is bad. That's the premise. And so they've begun with a hierarchy of why it's bad. So it's going to create hyperinflation. No, that didn't work. It's going to crash the dollar and cause a currency war. Nope. It's going to create a boom and a bust in the stock market. Nope. And down the list. So now we have people who would never consider, have no concerns about big tax cuts for the rich, arguing that QE is bad because it has bad distributional implications. So, I try to talk about some of these. The distributional one in particular I find very, very unconvincing. First, substantively, I don't think that QE arguably does worsen distribution. It raises stock prices, that's true, it's supposed to do that. But it also helps debtors versus creditors. It helps mortgage borrowers refinance at lower rates. It increases house prices, which we have a 60% plus homeownership rate. And most importantly, it helps create jobs, which is the most important criterion, I think. So I talk about that particular issue. I think overall there are some issues to be raised about QE, the uncertainty about its effects, the fact it does have some fiscal implications, although I argue that most of the time they're going to be positive rather than negative, but nevertheless there is a governance issue involved with fiscal. And I think it's very hard. It's hard to use because of the signaling aspects are hard to manage. And we're seeing again as both the exit and the entry into QE require a lot of intelligent discussion about exactly what it means for rate policy and other policies. So I don't think it is quite as flexible and as reliable a tool as forward guidance, but I do think it's there, something that we should keep in the toolkit. And so in this respect, I think on the tools issue, I think I'm pretty much on board with sort of the sequencing that Janet Yellen has talked about, which is that when the next recession comes, the first line of defense will be to cut short-term interest rates. Forward guidance will come into play very quickly. Only if it's a relatively serious downturn, and importantly, if we can't get any help from the fiscal authorities, will QE come into play. But if it does have to come into play, it will probably be constructive. Now, all that being said, I think I might disagree a bit with Janet in arguing that this will be enough in all circumstances. I think it clearly won't be enough, at least in the most severe downturns. And so then the question is, and this is the second part of the paper, is there a way to change the framework of monetary policy that will make monetary policy more effective despite the fact that nominal interest rates are quite low? And I'm taking, by the way, again, I'm taking low nominal interest rates as given. I'm not getting into fiscal policy that could have effects on long-term rates. I'm not talking about getting rid of currency, structural changes like that. So given low nominal interest rates, what can be done? So there are a number of suggestions out there. I talk about, in my paper, I talk about two prominent proposals, and then I introduce a new one, which I'm putting out there just for discussion. I'm not deeply committed to it at this point, but I think it's interesting and worth talking about. The two existing proposals that I talk about a bit are raising the inflation target and adopting a so-called price level target. Now, the idea of a higher inflation target is, I think, familiar. It's a very straightforward proposal. If you raise the inflation target from, say, 2% to, it'd have to be at least 3 or 4, I would say maybe 4 to have any real benefit in terms of creating space. But if you raise the inflation target to 4%, then you raise, presumably, the inflation expectations at all horizons. That increases nominal interest rates at all horizons. That gives you the greater scope for cuts, and that's a straightforward point. It has the advantage of staying within the current inflation targeting framework. It's pretty easy to explain. So I'm not completely ruling this out. I think there are some benefits to that approach. However, in the end, I come down opposing this idea for at least 3 reasons. One is I think that given that where we're starting from at 2% inflation with 2% well-anchored expectations, getting from 2 to 4 will be quite difficult. It is difficult to move inflation expectations. It's also difficult to re-anchor expectations at a higher level. So I think the transition would be very tricky, would create would take a very long time, would create a lot of uncertainty. Secondly, I think that economists sort of understate or underappreciate how unpopular a 4% inflation target would be with the general public. You could say that's due to bad understanding of what inflation is, but there are also some real costs of inflation. We don't understand them all that well. I suspect that if the Fed announced a 4% inflation target, there would be a very strong political pushback which would probably, at a minimum, would make the Fed's announcement less credible in terms of its sustainability. But I think that it would not be successful. But I think the more subtle argument, and the one for this audience, is that inflation targeting is a very inefficient response to the problem of low nominal interest rates. What we know, and here coming back to the theme of lower for longer, we know the optimal response to the zero lower bound is essentially this promise that when you hit the zero lower bound, that you'll keep rates lower for longer, or you'll have a make-up policy to compensate for the fact that you can't go any lower in the current short-term rate. All right, and that in turn implies that on the exit from the zero lower bound, you will have a transitory increase in inflation. So the optimal policy involves a transitory increase in inflation, but not a permanent increase in inflation. So Michael Woodford has made this point very well. In order to deal with the ZLB, the higher inflation target imposes a higher inflation rate on the economy at all times. And that's a very inefficient way to approach the problem. A better approach, and this is the second proposal, I think it's strictly better, is the price level target idea, which has been talked about, the recent ECB paper, Lars Svensson has been an advocate, others. The price level target idea basically is that instead of targeting the current inflation rate, you draw a trend line at 2%, and you basically try to hit that price level over time. The difference with a price level target and inflation target is how you deal with a transitory shock. So if you have a transitory shock to inflation, an inflation targeter just ignores it and it just brings inflation back to target over time. A price level targeter, though, will want to undo the shock. So if you have a positive inflation shock, then the price level targeters want to have a period of inflation below target in order to get price level back to the trend line. Now, that property of not letting bygones be bygones is good sometimes and bad some other times. Where it's good is, again, at the zero lower bound, because if you're at the zero lower bound and you have a period of very low inflation, so in the last 8 or 9 years, inflation has been consistently below the Fed's target. So what the PLT, price level targeting approach, would suggest is that you should be following that with a period of overshoot. And that means, in turn, that you're promising to keep rates lower for longer. That's exactly what the optimal policy says. There are, however, two disadvantages to the price level targeting thing. The first is that, as Olivier mentioned, you also have to have this offsetting policy away from the zero lower bound. So if you have a big oil price shock when you're away from zero lower bound, you've got to offset that, which means tightening very strongly to get inflation below target to offset that shock. That's a problem. The other problem is that I think it's a big change in framework, and I put some cost on that. If we can stay within something like our current framework, it would save a lot of complexity and confusion about changing the way we communicate. So in that spirit, I present and discuss in my paper, I won't have a chance here to go in any detail. How am I doing on time? I'm doing okay. So in my paper, and also in a Brookings blog post that was released this morning as well, in more detail, I look at what I call a temporary price level target. And the idea here is that it's price level targeting, but only at the ZLB, so that in a situation where away from the ZLB, when you're away from the zero lower bound, is business as usual. Ordinary inflation targeting, 2% in target, nothing different. But what you say in advance when you adopt this framework is you say, well, next time we hit the ZLB, we're going to care not only about inflation itself, but the cumulative inflation rate over the entire ZLB period. So we're going to be saying today, for example, we would look back over the period back to 2008 and say inflation since 2008, when we hit zero, is averaged only 1.5%. And in this new framework, which I'm talking about, which I want to emphasize is not a comment in any way on current Fed policy because they don't have that framework, but if they did, then they would be saying, well, let's have higher than 2% inflation for a while to get that average back to 2%. And that would have the effect, by the way, this is not, Olivier said it's hard to move inflation expectations. This is not about moving inflation expectations. This is about telling bond markets that when you're in the ZLB and inflation is below target, we're going to keep rates lower for longer. So what that's going to do is cause long-term rates to fall, And your average person thinking about buying a house is going to say, well, I don't know anything about the Fed. I don't care about their inflation target, but I see that mortgage rates are really low, so I'm going to buy a house. So it would have effects even if inflation expectations don't really move in the general public. So this idea, I think it has just a couple of advantages. One is that although I explained it to you in terms of price level targeting, it could be explained to the public totally in terms of inflation targeting. We're at 2% inflation targeter, and the only change is that in a ZOB period, we're going to be looking at the inflation target over the entire period and trying to make sure that the average inflation rate during this period where we're constrained is at 2%. And so it also doesn't affect long-run inflation averages either. So its communication, I think, is easier. And the other benefit of it would be, again, that away from zero, you don't have to offset inflation shocks. There's a lot more work to be done on these things. But I think the basic insight that I'd like to leave you with is that both between the tools and the frameworks, the best hope, I think, is to have a mechanism by which markets come to expect that the central bank will be very slow about raising rates away from the ZLB. And that, in turn, will, if that's anticipated, that will, in turn, reduce the incidence of the ZOB and maybe mean in the end that ZOB episodes are not even as long as they otherwise might be. So I think that's just, again, a proposal to put out there, and I want to reemphasize this is not a recommendation for current Fed policy. They do not have this mechanism in place. All right, so I have maybe 3 minutes. Let me say a few words about central bank independence, which there was interesting discussion in the previous session. So as was discussed, the traditional argument for what I'll call CBI, central bank independence, is the so-called inflation bias and the idea that politicians left on their own will be too short-sighted and they will push the economy beyond full employment. That would create inflation. So you need independent, more hawkishly minded central bankers to avoid that bias. And so now that argument doesn't look so good right now because, as pointed out, that first of all, inflation is too low, not too high. And secondly, the politicians in the US and Germany and elsewhere are actually more hawkish than the central bankers rather than more dovish. So what gives? Moreover, I would just add that you have smart people like Gowdy Eggerson saying, well, if you have deflation risk rather than inflation risk, that means fiscal and monetary policy need to coordinate for helicopter money or some other similar purpose in order to get inflation expectations up. So what I try to lay out in the last section of the paper is my case for why central bank independence is actually much broader than that. I think with respect to Larry's comment, I think part of my argument is similar to Larry's argument about, this is a very technical, market-sensitive, time-sensitive thing. You need to give it to experts. So it's subject to Larry's critique about why don't we give everything to experts. I think we actually do give a lot to experts. Take law enforcement. There are many things that involve detailed application execution where the agency is responsible in broad terms to the Congress, but not in terms of we try to keep the Congress out of the execution of specific decisions at the more micro level. But in any case, I think obviously there is a technocratic argument in terms of the market sensitivity, the need for communication, the need for coherence, consistency, that creates a need to delegate the policy. But then there's, I think, another right way to think about the next question is, well, okay, fine, but why not have experts in the Treasury rather than experts in the central bank? And I guess I would make a couple of points. One is that even if inflation bias is not the problem, politics is still the problem. I think a lot of the hawkishness in the United States had less to do with philosophy and more to do with just trying with partisanship and the party on the outside trying to hurt the plans of the party on the inside. To what extent, if the Treasury ran monetary policy, would there be a temptation to make an announcement on rates, to obscure some political problem that might exist? Would there be full credibility of forecasts, for example, if the Treasury were making the forecast? The other point, and this is my last point that I'll make, is that the arguments I've been making in the rest of the paper that to deal with the zero lower bound, you need to have forward-looking credibility. I think that's much harder if the Treasury is running it than if the central bank is running it. Alan Greenspan worked with 7 different Treasury secretaries. I worked with 4. There's a lot more turnover, a lot more short-termism. You change from party to party. The institutional continuity is much less in the Treasury. You need an institution that can develop a reputation for following a certain set of not rules in the narrow sense, but consistent policies. And that includes, for example, the ability to introduce something like a price level target, for example, or forward guidance. So I don't think this is a completely inviolable rule. I think there are circumstances in which the central bank can reasonably work together with other parts of the government, and I talk about that some in the paper. But I think the broader case for CBI, central bank independence, goes well beyond the inflation bias. Thanks.
Turn to the panel. The instructions were... Sorry? Thank you. The instructions were to act both as discussions and panelists, namely to react to what Ben had said, but also to give their own thoughts about other issues if they felt like it. We asked them to do this in 8 to 10 minutes. I shall try to enforce the time. Speakers really need no introduction. And so, Mario, please go ahead.
Thank you, Olivier. First of all, let me thank Ben. I really like this paper for 3 reasons. The first is an exhaustive and honest account of his experience in monetary policy during his difficult years. The second is that we have a lot to learn reading the paper, and even a lot to learn as far as our oncoming deliberations are concerned. I found very instructive his account of the reasons why the temper tantrum actually happened. Thank you so much for the honesty of that account. And the third thing is I love that part on the sociology of criticisms to QE, of course, as you may imagine. Mm-hmm. I actually I was thinking that it should be translated in 19 languages for the Eurozone, or especially for those who don't want to read English. But there is one aspect of this criticism that I just want to spend a word on, namely that all these monetary policies are distortionary by definition. And we can discuss for a long time what are the distortions inherent to monetary policy and what are the distortions that are unwarranted. But the bottom line is that if you create, as we've done in the Eurozone, 7 million jobs over the last 4 years, it's very true what you often say, that it takes a lot of hamburger triangles to fill a knock-on gap. So basically the bottom line is that distortions may be there, but sometimes the trade-off is so powerful that you just ignore them and do the right thing. Now, having said that, let me say why we are very different and why our experience in Europe has been different. And it's been different for mainly one reason, actually 2 maybe. The context in which our unconventional monetary policy started was completely different. And second, the institutional setup made them different. Just quickly, the beginning is the crisis, and the beginning is similar. After Lehman, our banks, the banks in Europe, mostly located in Germany, Netherlands, and France, that were heavily exposed to toxic assets, had needed to be bailed out. I think bails out, if I'm not mistaken, happened in Germany and the Netherlands and a few other countries. The figures, by the way, often people forget that, but the figures were staggering. Between 5, now depending on the estimates, between 5 and 20% of GDP was spent in bailing out these banks. After that, we have a second stage when the crisis spread to real estate. But basically, the point, I'm sorry, I was forgetting the important part. These bailouts were carried out in a relative, I would say, what we look at from today with today's eyes in a relatively tranquil fashion, over weekends mostly. And one of the reasons why this was possible was that these countries had strong budget and debt positions. So the bailouts never questioned the sustainability of their budgetary positions. The second stage was when the crisis extended to the real estate and touched Ireland and Spain. At that point, again, another wave of bailouts followed, but then the sustainability of the debt position and the budget positions and of these countries and their market access was being questioned. Then the third stage is when the Greek crisis shatters any delusion that sovereign debt could be risk-free. At that point, the crisis contagion spreads to Italy, Portugal, and other countries where the banks had not been touched by the previous wave of the crisis. They were not exposed to toxic assets. But they were exposed to their fragile sovereigns. Basically, their portfolios were stuffed with government bonds. So with that, the sovereign debt crisis morphs into a banking crisis, credit collapses, and the big recession starts. So they stopped lending. And the second characteristic is that this fracture happens along national lines, which in our institutional setup made a big difference. The fourth and final stage of the crisis is when all this combined generated a credibility crisis in the very existence of the euro. And that, of course, contributed further to what we viewed as a serious impairment in our monetary transmission channels. Interest rates faced by firms and households became increasingly divorced from short-term central bank rates. As a matter of fact, stressed countries faced asymmetrically restrictive credit conditions, meaning that monetary policy was actually tightening in the places where stimulus was most required. So all this explains why the unconventional measures we adopted in this period had a different focus from the US. They were not aiming so much at overcoming the zero lower bound problem. And we had a series of reactions of policies at the beginning of the end of 2011 and 12. Of course, lower rates were lowered in sequence 2 months in a row. Then we introduced the unprecedented liquidity lines with 4 years maturity at favorable rates. And then finally, in August of 2012, we had what was called the OMT, namely the announcement the central bank was ready to do whatever was needed. Now, all this had a dramatic effect on spreads and interest rates. Just to give you an idea, a few months later, in mid-2013, spreads had gone down by hundreds of basis points in France, Italy, 300 in Spain, 450 in Portugal, and of course, 1,800 in Greece. So all this basically shapes our monetary policy response and makes it, in a sense, different from what was designed in the United States, and also inspires the motivations that were behind our monetary policy. But then we reach a second stage when later on we had basically to design our unconventional monetary policy when our interest rates were at zero lower bound. So, but again, even in this case, there is a difference in the way we do policy. First of all, we've implemented an asset purchase program that encompasses both a wide range of public sector securities and private sector ones, asset-backed securities, covered bonds, and corporate bonds. Now, of course, this reflects the different legal mandates between the Fed and the ECB, but also the realities of making unconventional policy effective in our monetary union. We shouldn't forget that our banking system, as I said a moment ago, was weak. And so we had to find ways to carry liquidity to the system also outside the banking system as such, also keeping into account that non-bank intermediation had in the meantime gone up. By the way, let me just make a step backward now and make a reflection about what I said as a conclusion of the short history of the crisis and our reaction. And go back, I have 3 minutes left. Okay, so I will skip that. So if you ask me, if you ask me a question, I'll be glad to answer to that. So we had, and now let me focus on one instrument which is actually very different. And Ben says basically that the benefits of it and the costs of it are modest. And given the potential political backlash, it's not worth thinking about, which is the negative interest rate policy. So by opening up the lower bound, we've been able to drive overnight rates well into the negative territory and strongly anchor the short-term to medium-term segment of the yield curve, which in a sense made things different, very different from what happened in the United States. And since we paired negative rates with asset purchases in mid-2014, the short to medium-term segment of the overnight index swap forward rate curve, which affects investors' rate expectations most accurately, has clearly shifted down and became flatter. So more control, the lesson is we got more control on the short-term part of the yield curve through negative interest rates. By and large, our negative interest rate policy has been a success. We haven't seen the distortions that people were foreseeing. We haven't seen profitability, bank profitability go down. As a matter of fact, it's going up. And expectations of bank profitability is also on the upside. So basically, banks found other ways to make money. We haven't seen any problem with the money market funds. Again, that was one of the reasons why it was sort of not considered in the United States. And here we have to consider that money market funds in the US and Europe are different. And that partly explains, but as a matter of fact, we saw net inflows in the money market fund industry in Europe because the competition for banks has decreased. Now, what is also distinct in our case is our forward guidance, which is linked among our different policy tools. As Ben has just recalled, the foundation of this guidance applies to asset purchase program, which is both time and state-based. It will run at its current pace until the end of December 2017 or beyond if necessary, and in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with its aim. And then this is tied to our guidance on interest rates, which will stay at their present levels for an extended period of time and well past the horizon of our net asset purchases. The well past is obviously, as Ben has said in his paper, quite instructively, very, very important in anchoring interest rate expectations. So our rate guidance has also both time and state-based dimensions, since rates cannot rise until we see an improvement in inflation outlook sufficient to end net asset purchases. So this chained and sequenced forward guidance reflects the fact that expectations about interest rate policy and asset purchases are complementary, as actually Ben has said a moment ago. So policy commitments vis-à-vis asset purchases not only compress the term premium, but also reinforce the signal that the central bank will keep rates low well into the future. Forward guidance reinforces the stimulus from both our main policy tools. So the experience is that it has succeeded in preventing short-term interest rate expectations from creeping up, while asset purchases are still ongoing, which would nullify their easing effect. Finally, because I see that, how much is zero? Okay.
Negative rates. So.
Negative rates. So I'm going to negative rates. So one word about central bank independence. Now, of course, this discussion has a completely different color in the euro area because the independence in the euro area has also, I wouldn't comment on it, but different connotates from from the independence in a normal country, in a one country setup. But let me say one thing. Perhaps we are biased, but I think we've shown that we can be we've shown two things. First is that we can be, and we've been quite independent in achieving and in pursuing and achieving our goals. And the second thing is that it's not something that can be justified only by the argument that it's something for experts. In our case shows that there is another dimension which goes beyond simply the experience of the people who run monetary policies. So all in all, we are very, very glad that our independence is enshrined in our treaty. Thank you.
Thank you. Good. Ben?
Thank you. Let me start by saying that I really liked Ben's paper. Ben proposes an approach to policy that's elegant, it's straightforward to communicate. And I want to just focus on those elements that are particularly relevant for the challenges faced by policymakers and suggest some implications and complications. I want to do that, but I don't plan to talk about current policy. So policymakers in advanced economies, as we've been talking about throughout the morning, are confronting a different constellation of challenges today than those that dominated the canon of U.S. monetary policy making over the previous half century. A key feature of today's new normal is that the neutral interest rate appears to be much lower than it was in the decades prior to the crisis. So if you look, for instance, at the FOMC Summary of Economic Projections, the median participant expected a longer-run federal funds rate after subtracting inflation of about 0.75 percentage point, down sharply from the value when this projection was first published in 2012, which was about 2.25%, and that tracked pretty closely the 2.5% that we had observed in the several decades prior to the crisis. That very large reduction in the policy space available for cutting the federal funds rate to offset adverse developments can be expected to increase the frequency and length of periods when the policy rate is at the lower bound, unemployment is elevated, and inflation is below target. In turn, these kinds of episodes run the risk of pulling down private sector inflation expectations, such that the persistently low level of the neutral federal funds rate we see today, if persistent, may be a factor contributing to the persistent shortfall of U.S. inflation from target. Further complicating the ability of central banks to achieve the inflation objective in today's new normal is that we see a relatively flat Phillips curve, not only in the United States, but across many advanced economies, which means that inflation is much less responsive to a tightening labor market than we had seen previously. The academic literature, as Ben notes, suggests a variety of prescriptions for preventing a lower neutral rate of interest from eroding longer-run inflation expectations, but I think his paper argues convincingly that many of these proposals present practical difficulties that would pose a very high bar for their adoption, in particular raising the inflation target sufficiently to provide meaningfully greater policy space would at minimum engender public unease, or at the other extreme, risk unmooring inflation expectations. So as I have said previously, the persistence of the shortfall in inflation from our objective is a very important consideration for monetary policy. The make-up principle, in which policy would make up for past misses of the inflation target, isn't reflected in most standard monetary policy frameworks, although of course it's important in theory. And the proposal that Ben puts forward provides a framework that is both very practical and also implements that make-up principle, but it does so in a way that avoids the unattractive feature of a permanent price level targeting framework, which could require tightening into a negative supply shock. So the framework that he talks about would implement a temporary price level targeting framework only in periods while conventional policy is constrained by the lower bound, and then revert to standard practice away from the lower bound. That would effectively delay the liftoff of the policy rate from the lower bound until the average inflation over the entire period has reached 2%. It's designed to address what I see as one of the key challenges facing policymakers. Following deep recessions of the type we just experienced, there appears to be a very important premium on what people like to call normalization. We saw that in 2010, for instance, when there was substantial pressure among G20 officials to commit to timelines and targets for fiscal consolidation and to articulate exit principles for monetary policy. Of course, with the benefit of hindsight, it was clear this was premature, as was evident from the subsequent intensification of the euro area crisis. Moreover, the benchmark for normal tends to be defined in terms of pre-crisis standards that involve policy settings well away from the lower bound, perhaps because it takes time to learn about changes in the underlying relationships. So, for instance, the factors underlying what we now understand to be the new normal of persistently low interest rates were in many cases initially viewed as temporary headwinds, and policy was calibrated accordingly. A standard policy framework calibrated around an old normal may be biased to underachieving the inflation target. So in this set of circumstances, by pre-committing to implementing the makeup principle based on the actual observed performance of inflation, the framework proposed by Ben could guard against such premature liftoff and help prevent the erosion of inflation expectations. Now, of course, we, as monetary policymakers, operate in an environment of considerable uncertainty and have to weigh risks on both sides. In weighing risks of a breakout of inflation to the upside on the one hand, or an erosion of inflation to the downside, the standard approach is typically designed to achieve convergence of inflation from below. Given the lags in monetary policy, that means that generally interest rates are raised while inflation is still below target. Moreover, particularly in the early stage of recovery, again, this kind of preemptive approach tends to rely on pre-crisis empirical relationships. So during a lower bound episode, the proposal would represent a substantial departure. Instead of starting tightening preemptively well before inflation reaches target, the proposal would actually imply maintaining the policy rate at the lower bound well past the point at which inflation has risen above target. And so that is, I think, a very substantial departure. One risk, of course, with this framework is that the public may start to doubt that the central bank is, in fact, committed to return inflation to 2%. And there's also the possibility that given the large confidence intervals around inflation forecasts, the risks of an undesired overshooting of inflation is non-trivial. One additional challenge, as I see it in the proposed framework, is navigating a path for the policy rate immediately following liftoff that smoothly and gradually eases inflation back down to target and facilitates a gradual adjustment of the labor market. History suggests this is no easy task. Recall in the proposed framework that once the cumulative average rate of inflation has reached the target, policy would simply revert to a standard policy rule. That implies it would kick in at a point when inflation is above target and the economy is at or beyond full employment, which under the kind of proposal that's in the appendix or many other standard policy rules would result in a relatively sharp path of tightening. And that could undo some of the benefits of the framework. So let me just say a few more things in my remaining 1 minute. The other thing that I would strongly recommend is trying to incorporate into this framework the expectation, which I think Ben lays out in the paper, that in a severe recession we would see a combination of policy tools deployed again. We know that the way asset purchases have been deployed has been associated with greater discontinuity and discreteness, in part because of the newness of some of these tools. But it suggests that there would be, I think, a benefit from a more unified policy framework if you think about the way that policymakers talk about these tools. And let me just refer to the U.S. From the time tapering was first discussed up to the September 2017 meeting when the path for balance sheet runoff was adopted, you can see in the minutes and statements that FOMC participants considered the degree of accommodation provided by both policy tools in their discussions of the sequencing and timing of changes to policy settings, and discussions about the sequencing of what is referred to as normalization and the delay of balance sheet runoff until the normalization of the level of the federal funds rate is well underway, we're implicitly considering the extent to which maintaining the balance sheet may continue to provide make-up support for the economy while enabling the policy rate to escape the lower bound earlier than otherwise. So I think there may be a value to a unified, if nothing else, shadow rate. And I will conclude with that. Thank you.
Thank you very much. Philip?
Thank you very much, Olivier, and it's wonderful to be here among so many friends and former colleagues. Thank you, Ben, for providing such a rich paper. Ben, whenever I talk about you, or whenever I talk about monetary policy and the early days of the crisis, I usually refer to you as our then sort of chief architect in many ways. We all had to design our own plans based on our own legal systems, circumstances, our own specific problems, as Mario has mentioned. But I think there's no doubt that the master plan came from you and shaped our thinking and all our actions at the time. So being here today gives me a chance to say thank you, Ben. I was delighted, of course, to speak on this panel here and reflect on Ben's current thinking and what he sees to be the challenges and policy options that our successors will likely face in the future. It is, of course, true that the ultimate journey in our extensive unconventional policies, which were deployed all over the world, really is still out. On the whole, I would say it worked out pretty well, certainly when we consider the alternatives. Like you, Ben, my sense is that the alleged problems around unwinding the measures undertaken are probably overstated, with one caveat, which brings me to the role I thought I can perhaps usefully play here today by looking at the issues you have raised through the perspective of a small open economy and highlight a couple of notable differences. Unfortunately, for some small open economies with very limited sovereign bond markets, a balance sheet expansion can mean foreign exchange intervention, which adds some complications to the story. Most importantly, it introduces significant foreign exchange risk to the central bank balance sheet, which is of course not the case in the major central banks that Ben focuses on in his paper. That means, of course, that unwinding the balance sheet will be far more challenging insofar as one cannot rely simply on well-timed rolling off of maturing bonds. Unlike the case of the Fed, ultimately, presumably a long time from now, unwinding the balance sheet in these cases would require outright selling of securities at some point. Let me be clear on one point. Of course, not all small open economies resorted to FX interventions. My own country was a special case, given the enormous safe haven effects on its currency relative to the euro, which led to a completely distorted set of monetary conditions that could only be addressed by a forceful response by the central bank. So there's no question that for a case of a small open economy where FX interventions were a necessary feature of the balance sheet expansion, the policy choice of expanding the balance sheet entailed considerable risks, which incidentally, and here I speak under the control of Thomas, who's sitting in the audience, we pointed out very explicitly at the time of the introduction of the minimum rate. Therefore, Ben's reflections about a policy option that makes resorting to QE or to balance sheet expansion less likely is certainly important to consider for small open economies. And at least in theory, going forward, price level targeting is such a potential regime. I remember fondly a very good conference that Mark Carney and Jean Boivin organized at the Bank of Canada on PLT some years ago. Conceptually, price level targeting was appealing then, and perhaps even more so now in the context of what certainly looks like a persistent low rate environment and a high likelihood of the effective lower bound becoming binding once again quickly in the event of a major renewed downturn. By the way, I completely agree with Ben that while negative rates have played a useful role, not least in my country, as part of the monetary arsenal, any sense of using them forcefully going forward or more forcefully going forward is highly unlikely as long as we remain in a world where cash is used on a large scale, and this is certainly true in the case of Switzerland, where we still have very popular 1,000 franc notes. Now, unfortunately, if we think about the practical applicability of price level targeting on the specific case of small open economies, its feasibility looks doubtful to me. The problems begin with the fact that small open economies are more susceptible to foreign exchange swings than the major, much more closed economies. In Sweden, for example, the estimated exchange rate passed through to consumer prices is more than twice that of the United States. PLT would therefore require small central banks to lean quite forcefully against any shocks, which could presumably induce more volatility in output, and I'm not sure this would be a worthwhile trade-off. Moreover, and this is generally applicable, PLT would require that central banks really have the credibility to shape inflation expectations at all times, and presumably over a relatively short time horizon, although Ben pointed out in his presentation, perhaps this is not so much about price expectations, but much more about forward guidance. Nonetheless, it seems to me we have to ask ourselves whether we can really assume this to hold. Even now, in an environment of extensive monetary expansion and a synchronized global recovery, central banks appear to be struggling in a number of places to return inflation to target and keep long-term expectations from falling. Larry and Olivier referred to the case of Japan in their paper, but we can certainly all think of other cases here as well. For a small open economy, surely the problem could be even more pronounced. A small open economy or a small central bank, a small open economy central bank would hardly be able to go it alone, and PLT and some kind of global coordination would presumably be required. Based on my experience during the crisis, this seems a very difficult proposition in practice. Indirectly, this is one of the reasons why the SNB has always shied away from any attempt to define precisely what the time horizon is over which price stability must be ensured. Let me close with a couple of observations on Ben's extremely valuable discussion on central bank independence. The key takeaway for me here is that we need to make it very clear that coordination should in no way be seen as some sort of equivalence to the end of the independence of central banks. Like Ben, I remain convinced that the case for central bank independence remains extremely robust, both in theory and in practice. However, that must not mean that there can be, let alone there should be, no coordination between the central bank and fiscal authorities, or at the very least, attempts to broadly align between fiscal and monetary policy. This is, of course, particularly true during a time of a crisis. Indeed, inflation targets are surely easier to achieve in difficult times if both fiscal and monetary policy are at least more or less aligned in this goal. Recent history certainly suggests that without that, fiscal policy can make the central bank's task of returning inflation to target much more difficult. I would argue that the recent European example is a good one. One of the reasons the policy burden on the ECB has been so significant was that at least in the initial period of the euro crisis, fiscal policy on the whole pointed in the opposite direction. There is, of course, some good news in this, and I think it's important to mention this here in the US, in that going forward, there is now more fiscal space in Europe than arguably here in the US, and this might be an interesting point to Bob Rubin's question earlier on. So I actually believe Europe would have more fiscal space in the event of a renewed downturn. Coordination is, of course, even more important for financial stability issues. Without coordination, fiscal authorities may be unwilling to enact prudential measures, which might end up forcing the central bank to enact monetary policy measures that are inappropriately tight for the macroeconomy. Without going into details here, and again, I speak under the control of Thomas Jordan, but I can assure you that the rescue of UBS and the stabilization of our banking system in 2008 would almost certainly not have worked out, or certainly not have worked out as well, without close coordination between the government and the central bank. So I guess the way I have come to think of this issue of central bank independence is that central banks, or a central bank, is an organ of the state with wide-ranging policy autonomy for very good reasons. To conclude from that there must be no sense of coordination or cooperation, however, even loosely defined with fiscal authorities, strikes me as deeply flawed in theory and certainly in practice. Thank you.
Thanks. Adam.
Thank you. I am, of course, delighted to have so many current and former distinguished officials join us here at the Peterson Institute for this conference, and I abdicate to no one my admiration for what the Federal Reserve Board has done under Ben Bernanke, Janet Yellen, and their colleagues, what the ECB has done under Mario Draghi, Vitor Constancio, and others and their colleagues, and, of course, what the SNB, Philip, and my friend SNB Chairman Thomas Jordan have done. But I'm afraid that my feeling about all this is that even in Ben's excellent paper and their very real-world remarks, they have not rethought monetary policy enough. That in line with the initial statements made by Olivier and Larry this morning, it is incumbent upon us to take very seriously the failures, both real and perceived, of both policy and theory over the last 10 years. I'm turning on my timer. I think I'm not going to go into the issues of the rules-based policy and the particular formulation and proposal that Ben has put forward, and following on the good work of, as mentioned, Jean Boivin at Bank of Canada and Michael Kiley at the Federal Reserve and others. I would just make 2 points on that aspect. The first is that, as I've been arguing for some time, and as Jeremy Cohen-Sutton and I have tried to write, this constant referral to unconventional tools is ahistorical. And we must recognize that most central banks right up through the 70s engaged in asset purchases and other forms of administrative guidance that were perhaps suboptimal, but also did not, as Mario pointed out with respect to QE, cause enormous distortions and cause the temple walls to fall. And I do think as we force central banks rightly to take responsibility for some of the financial stability issues, there will be no way for central banks to avoid getting their hands messy and just say, oh, that was the emergency tools and now we're getting away from them. In fact, if anything, they will have to intervene more in other markets, and that will be unavoidable if they wish to deliver the results that their democracies want them to do. And in a sense, that's the message, although I won't put words in Philip's mouth, that's the message of if you're a small open economy, you have no choice but to do that, as Stan Fisher has said on this stage with respect to his being someone Fred Bergsten would call a currency manipulator, but having no choice when he was governor of the Bank of Israel. The second point I would make is while we toss about the name rules, we must remember that rules is a politically charged concept, particularly in the US discussion of monetary policy. It is not a neutral statement. It is a code word that is associated with the timing consistency view and with the idea that there has to be an asymmetric bias towards anti-inflation and towards the idea that central bank, the main problem of economies blowing up is central bank uncertainty. This is at best vastly exaggerated. I believe it is largely false. And I think as we shed the mistaken lessons of the 70s, or at least in more modest terms, as Larry put it, if we look realistically at what the agenda and the likely environment is for the next 20 years, we should shed some of this. So price level targeting as an operational idea, I fully am willing to consider, and there's much good discussion. But let's not cloak it because it's a rule, just as when Ben Bernanke, Thomas Laubach, Rick Mishkin, and I wrote about inflation targeting, we presented inflation targeting as constrained discretion as an alternative to rules. So let's just not go down the rules path. That is a place we should start, and that is something to take away from this conference, I believe, as we pick the new Federal Reserve. Let me turn to my 2 major points. The first point is, again, we need to rethink more. I take very seriously what was said by Ben, by Mario, and by many of us, including our colleague Joe Gagnon, David Stockton, and many others through the years, that QE and these other interventions may or may not have been as effective as we fantasized, but generally were effective and generally did not have the negative effects they were predicted to have. People talk about that in practical policy terms. They occasionally, in, say, columns in the New York Times, try to score debating points with that. But the main point is this is actually a challenge to old-fashioned macroeconomics. It is very difficult to reconcile with the idea that the Phillips curve is vertical in the short run and that forward-looking expectations are the main driver of actual inflation in the medium term with the idea that none of these side effects have happened. This is a genuine challenge to macroeconomics. It's not just a challenge to macroeconomic policy. If you believe the Phillips curve is a cloud, or you believe it is flat, or you believe it is kinked over the 10-year span that we've gone through this, and these very persistent pieces of inflation, of low inflation, when you have had enormous expansions of central bank balance sheets, and you have not seen the inflation that everybody predicted and expected. When you've had the central bank in Japan, for example, effectively give up much of what was considered independence, and you have not seen an erosion of anchored inflation expectations, it is unreasonable to keep harking back to the idea that in a short term, you have to treat the Phillips curve as rapidly vertical and inflation expectations as subject to rapid de-anchoring. That doesn't mean there is no long term. That doesn't mean one couldn't go back to the 70s, but we have to take seriously that that aspect of practice has to also inform our theory, at least in thinking about it. Moreover, I want to pick up and reinforce, again, in my own words, Olivier's call for a higher inflation target. Ben, among others, said quite reasonably, this is politically pretty awful, why we wouldn't want to necessarily do 4%. I would push back at this a little bit. When we wrote the book on inflation targeting, one of the things we assumed in the book, it's in the text, is that central bank, the people overseeing the central banks, the elected officials, could change their inflation targets frequently, or not often, but as needed. And I'm not putting words in Ben's mouth. For me, that's one of the things I most regret having written or co-authored or contributed to in that book. Because in fact, in practice, central bank after central bank treated them like exchange rate targets, where once we got to 2, we were very scared to adjust it, no matter what happened in the real economy, no matter what happened in the current situations. Because again, partly intellectually, you were worried about eroding credibility, and partly politically, you were worried about opening a Pandora's box. Nonetheless, if we take seriously the simulations that many people at the Federal Reserve, the Bank of England, the Federal Reserve Bank of San Francisco, the ECB, and on have done about the dangers of the zero lower bound, about the inability to target inflation very precisely, the trade-off for not creating a bigger space between us and the zero lower bound seems to me to be quite steep. And so I make 2 points practically. First is we have to think seriously about a coordinated effort, not fiscal monetary, but across G7 or G20 subset central banks to raise inflation targets simultaneously. There is a collective action problem that unless you're a very small open economy and quite desperate, you do not want to, and even then not often, you do not want to be the only one in the central banker club who suddenly depreciates or devalues your credibility. It also is harder to believe. So therefore, I think it is reasonable, since the inflation targets are set by elected governments for the most part, for them to coordinate and propose raising the inflation targets across the major central banks in a coordinated fashion. That would be the most credible, simple, lasting, and obvious way to make up for the price level undershoots of the past. It would also make it clear that central banks are accountable to their elected officials and that inflation targets like 2% are not written in stone. Finally, turning to central bank independence, as I mentioned, there was a marvelous conference at Bank of England, thanks to Andy Haldane and Governor Carney, that I got to participate in, and I already gave away part of the punchline, that I think the claim to central bank independence, even though it's a convenient debating point, and as Larry said, very compelling if you can say, well, it's the structural need for central bank independence, the actual claim has to be, frankly, a more proximate and pragmatic one that has to be re-won over and over by central banks, that this is an area of policy like the military, like judiciary, like certain aspects of healthcare, where you set the goals and you evaluate the competence of the people pursuing the goals, but you do not mess in day to day. This is the famous DeBell and Fisher operational versus goal independence. This is very much in line with what Ben argued in his paper. But I would go one step further on these issues of coordination. So there is this technocratic argument being made, for good reason, that we want to have better, easier coordination for fiscal monetary reasons, as was mentioned. But I think this ignores the actual direction where this bites. The issue, in part, throughout the crisis was not so much that we couldn't get central banks and fiscal policy to coordinate so they could do more fiscal policy. Another issue that was recurrent was fiscal authorities essentially threatening central banks, saying, we are not going to renew your capital, or we are not going to indemnify you against the losses for you incur doing QE. And you can see a marked difference in the political and independence environment in, say, the Bank of England, where I had the privilege to serve, where the chancellor repeatedly in a public fashion in successive parties gave an indemnity to the Bank of England saying, you don't have to come back to us for money if you lose money doing your monetary policy operations, as opposed to the Federal Reserve or in an earlier stage, the ECB, or recurrently at the Bank of Japan, where they kept making reference, I can't do X because then I might run out of central bank capital. We know central bank capital doesn't really mean anything, but then we have to go back to the politicians. And so I think thinking about independence has to go in that direction as well. Thank you.
Good. Thank you, Adam. I suggest that if any of you wants to respond to any of you, you should do it now. So is there any desire to come back in any way, shape, or form? No?
I very quickly. Those are very helpful comments. Thank you. I like Mario's comment. So I'm used to thinking about monetary policy in terms of interest rate space, but he talks about sort of the quantity as well as the price. You know, the problem that the banking channel might be, impaired, and the QE works on the quality of the transmission, or maybe even on the quantities of credit, for example. I think that's a useful way to think about it. Leo is exactly right that there is a transition issue about when you escape and you shift to the Taylor rule, whatever you're using. It's partly compensated by the fact that in my analysis, I assume a lagged adjustment term, so it's a gradual adjustment, but I think that's a real relevant point. An alternative is to take the ZLB inflation deficit as another term in a Taylor rule, so it just influences policy. It's not a strict restraint. And I didn't understand Adam's comments about rules versus framework. I once tried to explain to John Taylor why I thought that goal target, inflation targeting, other goal-oriented frameworks were kind of a rule, and he was violently opposed to that because his idea of a rule is one that gives you a specific adjustment, relates the interest rate to the output gap and to the inflation level, and he would strongly object to the characterization of these frameworks as being a policy rule.
Before I open the floor, I had two reactions. Well, one reaction, one question. The reaction is how different the QE has been across countries. I mean, what Mario was describing and then what Philip was describing about the importance of playing in the foreign exchange market, which is very different from anything the Fed did. And I think that's relevant in thinking about the future. The second question is a question to all of you, which is go ahead 10 years and think that we're in normal times. There is no financial crisis right now. There could be, in which case you're ready to provide liquidity and do QE and do all these things. But it's not there. How do you conduct monetary policy then? I mean, is it very much like the way it was, which is there's a dual mandate with output and inflation, and you use the policy rate because you're not at zero lower bound? Or is it very different? So I don't know who wants to
Well, that was my
to
proposal.
start.
My proposal was away from the ZLB.
Okay, so Ben, I think, has given an answer, which is one modification of the existing scheme. Mario, do you feel like answering?
I'm not sure I understood the question. You're assuming a world where things are normal.
Right.
Then you go back to normal.
Is the normal the same as it was? And there are many things which
Well, how
where
do I
normal
know?
has been redefined.
Yeah, but I mean, how do I know where it's normal is the same as it was? You're going back when you see output gap closing, countries going gradually to full employment. You see nominal wage growth, which was subdued, picking up. You see your inflation gradually aiming towards your objective in, as we say, sustained and self-sustained and durable manner. And then you gradually adjust policy. You go back to normal. It's, I think Janet is absolutely right, thinking that probably a QE is not going to be the standard monetary policy tool for all circumstances. But, I mean, we are so far, it's such a high-class problem. I mean,
It's the difference between you and me, Mario. Mario, you have to think about what happens next week.
That's right. I mean, just
You can just look at what happens
such a
in the...
high-class problem to think about that. Now, with our main focus, and here, in a sense, I am addressing some of Adam Posen's remark. Our main problem now is to see why is the nominal wages response to the improving conditions in the Europe, which is unquestionable. How is this response going to be shaped in the coming months? Why is it being slow if compared to previous crises and previous similar positions in the business cycle and so on? So we're looking very intensely to labor market conditions, wage bargaining, trade union strategies, and of course our situation is heterogeneous, so we have different realities, different paradigms, and we are seeing something, but we're still not there. And that's our main focus today. So if you ask me in 10 years' time, well, just help me to figure out that reality, and maybe I'll be able to answer.
I'll invite you again. Niall, do you feel like taking up the question?
No, I think this conference is addressing a question as to whether normal has changed, and I think that is certainly in the sort of work that I've been doing in the policy arena. It does indeed seem that the pre-crisis normal is not a good guide, that there is a new normal, and that there are two features of that new normal that were in many cases initially viewed as temporary headwinds associated with the crisis that now I think are increasingly being viewed as potentially quite persistent. And you talked about them this morning. The first is a persistently low neutral rate, and that really does have very profound implications for monetary policy. And the second, which Mario just mentioned, is that we really aren't seeing the kind of responsiveness of inflation to a tightening labor market that has been a kind of classic transmission mechanism in the past. Now, I think what Ben was trying to do is set out a new normal kind of a framework that would allow us in most circumstances to retain, but I'll let him speak for this, retain a customary approach to monetary policy and have in place an anticipated zero lower bound change in regime that would try to adapt to the new normal. But of course, you could instead think about an entirely different policy framework, and that was some of the other proposals that are being discussed.
Philip, you feel like...
Yeah, I would just say, I think, like Mario, I think if we are in the scenario that you described in 10 years, it'll be fairly similar, with one big difference, that we will know that there are these instruments that we used and that worked reasonably well. And so I guess the question will be where they will be on the sequencing of deploying them. And I think, as Ben suggested, I would also think the QE remains kind of at the back of the queue in terms of the policies that you use. So I think it's not clear to me that we will have a radical change in that environment. The much more problematic case is the one that Larry put out there. What happens if we really have a major downturn in the near future? That's a far more complicated and presumably relevant question, I think, at this point.
I just want to commend President Draghi and Governor Brainerd for taking up the issue of wage inflation, and they've been very clearly focused on that in their recent remarks. And I think that is, again, critical, not just politically for establishing symmetry by central banks, but is the key transmission mechanism. So I think that is where the focus rightly is going.
But Mario, you wanted to come back?
No, just one hint that Adam Posen made about the sort of need to coordinate internationally the rate of inflation. I think you are absolutely right. That would be actually the right thing to do. We've thought about this in the past few years. How much better would how much simpler would our monetary policy be if this were possible? But you just sit down and think about this. It's not easy. It's not easy because you got to agree about lots of other things, where agreement at the present time is unlikely to come easy, and where agreement about that, an international agreement of that nature, cannot be an agreement between central banks only. It's an agreement between governments, executives. So
Which is what I called for.
Sorry?
It's explicitly what I asked for.
Yeah. Okay.
Good. Okay, questions from the floor. I have Ted Truman. and then I have Stan Fisher.
Ted Truman here at Peterson Institute. So I'm pretty sure that this question is addressed in your paper, Olivier, and it may be in Ben's, but I haven't heard it from the presentations. And that is, there's implicit assumption, I think, that balance sheets, central bank balance sheets need to be reduced to some degree, to be reduced. And it seems to me that the case for that has not been very clearly made. And I wonder whether what the panel thinks about that in going forward. Thank you.
Ted, I've written some blog posts exactly on this issue, and I think there's a bunch of arguments for keeping balance sheets not necessarily as big as they are today, but for certainly much larger than in the past. One in particular that I like is I think there's some benefits to having, as the ECB does, sort of long-term relationships with banks where they continually have both reserves and borrowings, which gives you more flexibility with less stigma to deal with liquidity provision during a crisis. Jeremy Stein is here. He's made some arguments. The Jackson Hole Conference, had a number of arguments about improving transmission, providing a safe asset. So I think there are some arguments. The FOMC is extremely clear about not looking at any of those arguments, and obviously is very interested in getting as low as possible. Although, given their interest in the so-called floor system of implementation, it does appear that they're aiming towards a balance sheet that will be much larger than in the past. So possibly this is somewhat moot question. But I agree with you that the urgency of radically reducing, I don't know what you think, but answering your question, I don't think that radically reducing the size of the balance sheet is necessarily the best strategy.
Let me, and this is their session, but given that I've worked and talked about it, let me just say, yeah, I think it's not urgent. I think that there is fairly strong arguments for example, wanting to reduce the term spread. If you reduce the term spread, that gives you a bit more leeway in terms of hitting the zero lower bound, because it allows you to have a higher rate for a given long rate. I think there are many reasons why you may want to play with the yield curve on a steady basis, but in most cases I've concluded that the Treasury can do it rather better than the Fed. And so the question is, why should the Fed do it, is the way I think about it. I had Stan Fisher next.
Thanks. I'm Stan Fisher on my way out of the Fed. Just 3 comments. If you have an exchange rate problem, you also have a choice, which central banks have been making for a very long time, between sterilizing or not sterilizing their interventions. And that actually can be described as a form of quantitative intervention. So they invented it first, they just didn't know it. Secondly, on the cooperation between the central bank and the fiscal authority, I think in any case, whether your aim is coordination or not, you'd be better off with an independent central bank, because in an argument with, if you're trying to get to the social optimum, you're more likely to be close to the social optimum if the weight of both those bodies are taken into account, rather than having the decision made by a single decision maker. So I think that would be fine. There's another argument as to why the central bank should be independent, which was made very dramatically by John Crow, the Canadian central bank governor in the 1990s, which was, he said, I never talked about fiscal policy ever as governor of the central bank because I knew if I did, the finance minister would come to me and say, let's make a deal. We'd make a deal. I'd do what I was supposed to do. A year later, he'd be explaining to me how difficult it was to get it through the parliament and all that sort of stuff. So it wasn't worth getting into the discussion in the first place. Well, that's another way of looking at central bank independence. The third thing I thought I might mention to both Ben and Adam is there was a literature in the 1990s advocating flexible inflation targeting. We've been talking about flexible inflation targeting all day. And what you're doing is putting some content into what the flexibility is supposed to look like. And Ben has proposed a set of rules for flexible inflation targeting that seems to make some sense. This is also something which has been done by several countries that have a target range for the inflation rate. And that's a matter, or that is something in which the central bank can change the inflation target as long as it explains it. And it would be worth taking a look at whether those who have this range, we had it in Israel, I found it immensely useful, have done better, or how they've used it, whether they've used it optimally. So there is some experience there. And then you get to the question of what is the framework in which you do what Ben suggests. Is it something where you have rules? Is it something where you rely on discretion with more flexibility for the central bank? I think those are interesting questions, and my tendency always is to believe in a bit more discretion being better than a bit less discretion. Thank you.
Does anybody want to answer Stan?
Maybe just stand on the sterilized intervention question. So we obviously thought about that, but reached a conclusion very firmly, and the evidence on the operational side really underpinned it, that if we tried that, the effect would not be there, that it would be hopeless to try to get the monetary conditions where we needed them to go if we tried to do that. So it was, we would have all preferred to do it that way.
If you try to do what? You said
To use sterilized interventions, yeah. But it simply would not have had the effect in terms of the monetary conditions that we needed to fulfill our mandate. And we actually had some operational evidence of this in the early days, so it wasn't just a theoretical observation.
Good. I have Andy, and then...
Thank you, and thank the speakers for a wonderful set of presentations. I had a question. I think all of you in your comments took the, what is in English, the ZLB, what is in American English, the ZLB, as a given, as a constraint. And my question to you is, should we take that as a constraint, or are there things that we as policymakers could or should do imaginatively to either loosen or indeed to remove that constraint by doing things about cash? Thank you.
Anybody wants to answer?
Sorry, by doing what?
Moving
cash.
Oh, moving cash.
No? No, nobody wants to say anything. I mean, well, Philip, you want to go?
Look, I mean, I did refer to it indirectly that would have to be the assumption if you wanted to use negative rates any more aggressively than I think the SNB tried, successfully, by the way. But I think, they were close to where you can go in an environment of cash, particularly, again, the Swiss case where you have a 1,000-franc note is really something that you have to watch. I remember the first time I saw the reserves or the spare cash in a hidden, undisclosed location, and was struck how little room it takes to store a lot of value when you have 1,000 franc notes. I know this is a favorite topic, Larry, of yours a long time ago. But talking about the political economy, certainly in a kind of Germanic setting, if you came with that idea, that's an interesting theoretical discussion, but I think in practice, it's entirely impossible. In fact, the reactions to Ken Rogoff's book at the time in Switzerland, and I think the same was true in Germany, were bordering on violence. So who knows what happens in 30, 50 years? Who knows what happens if Larry's scenario comes to pass and we find ourselves at an impasse? But I think for now, to me, it strikes me as a very theoretical question.
We of course, also want to look to our colleagues at the Reserve Bank of India and others to see how their demonetization shock went. That's flow rather than a permanent regime change, but obviously that's interesting. And also, if this is the world for the next 10, 20 years, it'll be interesting to see if China, therefore, is less constrained by the zero lower bound, because there's clear evidence that cash is disappearing in China, as you know better than I, in favor of mobile payments on a very large scale. So it'll be interesting to watch if they avoid some of our problems for that reason or not.
But I think as we move away from physical cash, and will continue to do so, I think the scope to actually have negative rates will steadily increase. I mean, if the central banks decide to issue digital currency, it will be easier to have negative rates on digital currency. Now, people will still be able to hold the cash, the physical cash, but I think it will become less and less attractive as an option. So I think the future implies that we'll have more room to do it, leaving aside the psychological aspects of that. I had you next.
Thank you. Joachim Fels from PIMCO. I have a question for Ben Bernanke. I would like you to help us think through the counterfactual. So what if your temporary price level targeting rule had already been in place when the Fed hit the lower zero bound? What would the current situation look like? Do you think we would still be stuck at the zero bound? Or would you argue that if the rule had been in place, inflation expectations would have been higher, so actual inflation would not have been as low, and we might actually be at a Fed funds rate that is higher than the current level? And then additional question, you seem to link your rule to the interest rate tool only. Why not go one step further and link it to QE as well? So to say, as long as average inflation since the zero bound was hit is not back at 2%, we actually we not only keep rates low, but we also keep buying bonds.
Well, the latter thing was Lael's suggestion about having a more unified framework, and my only response to it is just trying to keep it simple. I mean, we can think it through. The trouble is when you start having multiple dimensions, it just gets more complicated. But your first question, I've asked, by the way, some Fed colleagues to try to simulate some of these things to get more quantitative assessment of how this would work. So I don't have those answers yet. But in principle, this is different from ad hoc forward guidance that comes out in the middle of the ZOB period, because if this was part of the framework, it might have reduced, I think in steady state, it would reduce the incidence of ZOB episodes, because people would, even as you got close to zero, markets would begin to anticipate this possibility, and so that would cause long rates to be bid down further than under the current regime. And likewise, in the more recent episode during the ZOB, we had rounds of QE, and we had various rounds of forward guidance that acted to push down long rates. Some of this might have happened earlier and more sharply under this regime. So it is possible. This is why I want to be very cautious that my illustrations in the paper using the recent data are not meant to, these are counterfactual. We don't know exactly, but it's certainly possible that if this had been anticipated even before we hit zero, that accommodation would have been stronger, and we would have escaped from zero lower bound even earlier than we did. It's certainly possible. But again, I don't have quantitative answers to give you today.
Bill Klein here at the Institute. I'd like to ask Ben to say a little bit more about how to think about the welfare cost of going from permanent 2% inflation to permanent 4% inflation. We used to have the misery index in this town, which had an equal weight on 1 point of additional inflation, 1 point of additional unemployment. Indeed, the Taylor rule implies a welfare weight as well. So is it just that the public can't understand what we economists know, that 4% would be just fine? I think the one factor that Olivier left off his chart today, which is the inequity, could be compromised by having 4% inflation over a long period of time. We haven't had adjustment in minimum wages for a long period of time. So over 10 years, that's a 50% reduction. So I wonder if you could help me think a little bit more about whether there is a welfare cost to 4% inflation instead of 2% inflation.
Yeah, there's a lot of disagreement, of course, in exactly how big the welfare cost is, but I would refer you to the Kiley and Roberts paper where they actually try to do the exercise, and they say, suppose you've got quadratic loss function, and so inflation above 0 or inflation above 2 imposes an increasing marginal cost, and then you've got a cost also of having less stabilization in the economy. So obviously a higher nominal interest rate makes you better able to stabilize output, but gives you the higher inflation rate. And they do some illustrative calculations. Obviously, if you think there's no cost to inflation, then you're fine with the 4%. If you think it's a moderate cost, then perhaps you're more worried about that trade-off. The point I'm trying to make is kind of a dominance argument that even if inflation costs are not that high, they're more efficient policies that don't involve high inflation all the time. So as long as inflation has meaningful costs, then you would want to have something that is more focused on the period where you need to have the additional stimulation.
I will resist the temptation to comment on the central bank independence issues and just ask a different question. Several of you commented on the puzzle of of inflation not having accelerated in the way that many would have expected. If you had to guess, when we understand that all better, 5 or 10 years from now, broadly there are two possibilities. One is we'll still have the same paradigm, but we'll have changed our mind a bit about how the natural rate evolved, and we'll have changed our mind about how inflation expectations were evolving, but we'll still have the same kind of Phillips curve view at the center of it that we do now. And the other view is that in some way that I don't think has been made clear by anybody, we'll have a different understanding of the inflation process more broadly than the kind of understanding that we have right now. And I guess I'd be interested in people's views on how likely it is that it'll be sort of quantitative and within paradigm versus how likely it'll be that there'll be a differing understanding of the determinants of inflation.
Yeah, I think it's not going to make any difference as far as policy is concerned. Right now, with the muted response of nominal wage growth to the improving economic conditions, our policy in the euro area at least, the terms we use is to be confident that it will converge because we think that inflation is a monetary phenomenon, but it's got to be patient and persistent and prudent about making changes. Suppose we were persuaded that inflation actually was were to obey to a different astronomical law. Would you change policy now? Would you actually stop QE and raise interest rates to that extent? No. So from practical purposes, from our narrow-minded central bankers' viewpoint, that's the answer.
Anybody else?
kind of easy. That's kind of easy for you to say.
Absolutely.
In the context, I don't know whether anybody's going to want to comment. In the context of the American debate, a centrality of a Phillips curve, slack to inflation, don't want to get too far behind the curve, seems to be a central part of a policy action that markets regard as likely. So you may be right about your particular situation right now and your current decision to not be raising interest rates and not signaling that you're going to raise interest rates. But for others who are sort of nearer the bubble on that, this issue seems like a larger issue.
Well, maybe, I'm sorry, I just answered. I think I'm right also in other contexts. And the reason being that, yeah, I mean, whether you are closer to the end, to the closure of the output gap, and whether you're closer to full employment, would, regardless what the explanation of inflation is going to be, would certainly ask you to think about whether current policies are still right or not. But that is regardless on whether inflation obeys to a different law other than the Phillips curve. But because the answer to that problem, if it were so that inflation actually obeys to different law, then the answer to that is not so much monetary policy. And I think you've said this. It's other policies. So from a central banker viewpoint, whether you're close to the closure of the output gap or you're distant, isn't really 100% relevant to that question.
So I'll just speak to my own.
Sorry, I invaded his
No,
interest.
I think that response was to you. So I'll just speak to my own wrestling with this question in the U.S. context. So if you just look at what's happened to unemployment and what's happened to inflation, unemployment has gone from over 8 to just a bit above 4 at a time when inflation really hasn't gotten anywhere closer to 2%. And that seems to be true over a longer time period as well. It's not so much that the Phillips curve isn't operative. It seems to be that the Phillips curve is just not very important in the overall inflation process. More broadly, temporary factors seem to be an important explanation, but just as this year we saw temporary factors driving inflation down a bit, we saw temporary factors last year driving them up a bit. And so that, too, I don't think can fully account for what we've been observing in the inflation data. There does seem to be a very important persistent underlying trend in inflation. And there, a lot of the time series work would suggest that we have actually seen a reduction in the underlying trend rate of inflation that's material. And there's a question mark about how do central banks affect that over time. Now, if you look at other measures that are closely related to that in concept, expectation measures, there you have a bit more of a mixed bag. Some market-based measures of inflation compensation show the same kind of reduction. Similarly, household surveys, not so much in the professional forecaster survey. So I think it's a bit of an open question. There seems to be a global factor there as well, but I don't think that in itself explains what's going on in the inflation process domestically.
Larry, I think from a market perspective, your question, of course, is highly relevant because likely the one way this kind of cycle could come to an end would be if inflation starts to suddenly pick up. So I think the way we try to think of this is if you look at this problem in calendar terms, then you'd have to kind of wonder what's going on because we're in the 32nd quarter, I think, of this expansion in the U.S. And so your question would be entirely kind of validated. Why is inflation not picking up given the unemployment rate and all that? If you look at it a bit more in a more subtle way and kind of think about how much of the excess capacity that has been created by the crisis has really been absorbed, you could argue that we're not anywhere near the end of that cycle. So if you think in quantity instead of calendar, in a sense, you can easily see that it could take another couple of years if we continue to grow at or just, slightly above potential before we get to the point where, in fact, you would expect inflation to really pick up. So my guess is that's kind of the world we're in. If you look at Europe and other parts of the world, of course, it could take even longer. The cycle is probably we're further behind in those places. So if I had to answer your question, I guess I would say in the end, it will be a fairly traditional way in the sense of how inflation will react, how wages will react. It will be much longer in calendar terms, not necessarily in quantity terms. And there may be longer-term structural constraints on how far this is going to go around technology, around demographics. You mentioned some of them in your own paper. So it's probably kind of a 2/3, 1/3 answer of the two options you laid out.
The answer to your question for me is an emphatic yes to the first hypothesis, which is I cannot think of an alternative description of wage and price setting, which doesn't say that when the labor market is sufficiently tight, firms will want to increase wages to attract workers or keep workers. And once they have done this, they will try to increase prices, maybe not one for one. But I just cannot see. After this, what form it takes depends on foreign competition, all kinds of things. But the notion that a tight labor market will lead to more inflation, for me, is impossible to contradict. So the way I read things, as you know, because we've discussed it many times, is I read the evidence in the US as telling me that U-star of the natural unemployment rate is low for all kinds of reasons, which I can guess.
One of the red lines, when, as you well know, Olivier, one of the red lines you set in our paper was that structurally low inflation was not a possible new reality that we could discuss because of your view that the Phillips curve was right and your tautologous procedure of inferring U-star from the behavior of inflation. And I was asking my question to see whether there was some wider spectrum of viewpoint than the one you had provided.
So it sounds to me like...
Please identify yourself.
Oh, sorry. Niti Bala from Liberty Mutual Investments. It seems to me that you've all sort of articulated that forward guidance and some form of quantitative easing and whatever we call them, unconventional tools, are still in the toolkit, but potentially more in emergency situations, or how you sequence them is something that seems to be a discussion point. What I'm curious about is in an era where central banks are intending to be more transparent, what qualifies as emergency? And the way I think about that is at some point over the next, call it 5 years, do you all think there would be some form of a recession, be it in the US, be some sort of a crisis in China, be it, whatever, some sort of a dislocation? What qualifies as emergency, and how do you start to then think about the sequencing and whether these are conventional or unconventional tools given where rates may be at that point in time?
Well, in narrow terms, in narrow terms, an emergency is a situation where cutting the short-term rate to a low level is evidently not going to be adequate to achieve the central bank's objectives. I think the forward guidance actually, just look at current policy. I mean, it's evident. I mean, a lot of the current guidance is Delphic, as I described it, more forecast than commitment. But the willingness of central banks to talk about future policy is obviously much higher. And I think a certain amount of forward guidance is likely to come in even in moderate situations. But the definition of an emergency is one where you can't achieve your objectives with a close to zero short-term interest rate.
Joe Gagnon here at the Institute. One of the things that it seems became more apparent to me in the past 5 or 10 years is that maybe asset markets aren't as efficient as we thought, and when central banks buy certain types of assets, they can affect the price, and I think that's exactly what you said, Ben. We don't have the best theories about how that works, but it seems to work in practice. But if you take that, then it would seem that maybe central banks have a lot more tools than we thought. If we buy long-term bonds, we can drive long-term bond yields down. But if we buy equities, we can drive equity prices up. If we buy corporate bonds, we can drive spreads down. If we buy packages of bank loans or subsidized lending to banks, we can reduce other credit spreads. Is this worth pursuing? Is this, as an alternative, it seemed like the message I was getting was, well, we might be running out of tools pretty soon because if bond yields get very low, QE will have limited room to operate, and we need to think about these other price level targeting or the other options. But is an option, another option would be that you haven't mentioned, other assets, other markets that central banks could work in.
Well, here's a fellow who can do all that.
Yeah, I mean, that's our experience shows that we ran our programs and our policies with great flexibility. I was saying at the beginning that our asset purchase program encompassed certainly sovereign bonds, but corporate, covered, ABS. So it was a wide range of securities. And flexibility has many dimensions, one of which is the scope of different assets that are being bought. And the choice, of course, depends on what is your transmission channel, what is the institutional setup, what is your transmission channel, what is the state of health of the banking system, what's your mandate. So the answer is yes.
Does this conceptually extend to equities?
BOJ went into equities, for example. That doesn't mean that everybody else should do the same. It really depends on the institutional context and the setup. Probably they must have thought that that was the most efficient channel at that point in time. Also, the balance sheet of BOJ is something, if I'm not mistaken, 85% of GDP. That was also the outcome, must have been the outcome of a sort of deep thinking about the size of a balance sheet. So, but I think if I can say one thing that comes out of my brief presentation is that our monetary policy response was both determined by the specific context in which it was originally designed and by this specific institutional setup which we had to face with all its strengths and its fragilities.
So two different questions, one motivated by the previous. Okay, I won't do the whole preface part. The first is, if you're trying to figure out the Phillips curve and figure out whether it is that the intercept fell because the narrow is lower or it's flatter, just looking at one data point is not going to help you pin that down. And we've all been talking about one data point, which is the recent experience with low unemployment and low inflation. If you bring back the discussion we were having 6 or 7 years ago, that we had a very high unemployment rate, but we didn't see as much fall in inflation as we expected to see, I think that gives you a flatter Phillips curve. My question would be, can you rationalize this, that Olivier, your theory is right in a world where you eventually run out of slack, but maybe we should think of slack as the 35% of people who aren't working right now in the United States, and that there's just this huge reserve army of people outside the labor force that can come back in, and until that exhausts itself, which is never, you know, we want to think of this as flat, which is to say it's not a Phillips curve. I'll actually just do that one question.
I think, yeah, this was more a statement than a question, right? That the, yeah, I mean, we all know that looking at just unemployment is not enough. You have to look at labor force participation. It may all be that, again, the notion that when the market is very tight and firms cannot find workers, I know wages will increase. When this happens, depends on how many unemployed are willing to work, on whether people have dropped out are willing to come back. So in practice, getting the curve, getting the equation right is tough, although not impossible. I mean, I've written a paper last year which basically said, you know, I can fit the data. There's nothing terribly unusual. The slope is very flat. Expectations are very sticky. And that basically gets you a fairly good fit. But in practice, exactly what matters, whether it's you or labor force participation, that's open.
But if it's flat, it's not really a meaningful concept.
Flat is an issue. Some slope is okay. Well, if so, any last words from any of you?
Can I actually say a word when you stopped me and you said I didn't have time? And this is not about Ben's paper, but about yours. You seem to have a geological view of crisis. Namely, you talk about tectonic shifts, and it's kind of something imminent, something deterministic, something you can't do much about. And everything that's been done, now you don't say, I'm actually making it a little extreme here, but everything that's been done so far, it's not enough. So the whole policy response since the beginning of the crisis wasn't really enough and will not prevent us from the next crisis, which may well be true. It's like the sort of the checkbox that Ben was hinting at about his monetary policy. We'll find a set of circumstances where this isn't true. But if you, I'm not saying this, so it may well be right what you say, but rather than focusing on the tectonic shifts, another way of looking at this is focusing on certain regularities that you've seen over most of the crises of the last 15, 20 years. Namely, you always see a lack of fiscal space. That's the most diplomatic way of saying that maybe it's because your debt is high, maybe because your deficit is high, maybe because your service over GDP is high. There may be many reasons, but basically you don't have lack of fiscal space. I made the example before of two different countries having the same banking problems, Germany and Netherlands versus Italy and Portugal. And somehow you want to have fiscal space at times of crisis. The second regularity is weak banks, lax regulation. So you want to have strong regulation, you want to have strong supervision, you want to have strong macroprudential framework in place. I think, and then the third, of course, which is specific to the Eurozone, you want an institutional setup that is not fragile, that is by and large complete. So don't you think that focusing on doing whatever you can do to fix the weaknesses in these areas, and there may be other areas as well. By the way, I think the point made by Larry before about lack of structural reforms is probably most likely the most important of all the weaknesses that I mentioned before. Don't you think that that's sort of better than focusing on sort of the sense of imponderability that you have in crisis in your own description?
Use a big word. But I'm slightly more optimistic about what we can do about financial crisis than what we can do about earthquakes, in the sense that plate tectonics, at best we observe, but we can't do anything about. Where I think in the case of the financial system, we actually observe and sometimes we can do something about. So I have no doubt that we can do things ex ante to basically decrease the pace at which the plates are getting together. Am I optimistic that we can do it so it never happens again? No, because we basically know when there's a credit boom that half of the people think it's a good one and half of the people think it's an unhealthy one. And only exposed do we find out. So, but yes, I mean, the comparison only goes so far. And I surely, this should not be taken as a statement that nothing can be done, therefore just be ready for it. The point was, I'm not sure monetary policy is the right tool. Macroprudential, I think, is the right tool. And it can be done, but we have to be realistic about how much it will change the probabilities in the end. I think Adam? Oh, Leo, please.
No, so Leo, please.
No, I think just building on that, the one thing we really haven't talked about is in a low neutral rate environment for monetary policy to be able to be unconstrained in the way that Ben is suggesting in order to avoid kind of deteriorating inflation expectations and performance. You really do need a very complete set of tools to guard against the heightened risks of financial imbalances and financial instability, be that structural tools, which we have in greater supply in the U.S., or macroprudential tools, which are somewhat less tested and which are somewhat more limited in the U.S. context, but in the absence of a very rich set of tools to guard against the potential financial stability risks, I think the ability to use monetary policy in the way that's suggested will be somewhat more constrained.
Yeah, so that's all I was going to say was housekeeping. Olivier will thank all our distinguished speakers. We have come to the close of the morning session. Thank you for those of you who powered straight through, including online. There is now lunch available for those of you who are here. Those of you watching, find your own lunch. And we will reconvene at 1:30 p.m. sharp for the fiscal policy session with a lead-off paper by Alan Auerbach, and then the financial stability session with a lead-off paper by Andy Haldane. Thank you very much.
Thank you.